Joining us now is BMO Capital Markets analyst John Kim. John, good to have you. Sorry I'm not there in person with you. You've had an interesting call in the past. I would assume this move down recently is just on rates. How do these things typically perform historically when we have the 10-year soaring to new recent highs?
Thanks, David. It's not a great time to be a REIT analyst, let alone investor. But with interest rates going up, at the same time, demand is really slowing across most asset classes. There's just a lot of uncertainty with asset prices. So we think that needs to settle out. We need to see some kind of settlement on interest rates. I think the opportunity is really on the supply side, because supply is really coming down as far as development starts across most asset classes. So we'll see that really come into fruition in 25. So 2025 looks like a really great year in terms of fundamentals for real estate.
What about the underlying financing, for example, for either new or existing developments that perhaps have maturities that are coming due, and what that may mean for the overall sector if they have to refinance at a higher rate or simply unable to? Again, I come back to offices, but more broadly speaking across the board.
It's creating a huge uncertainty in the markets, and you're seeing that in stock prices today for the office REITs. Right now, it seems like the banks are willing to work with the owners and kind of kicking the can down the road. But we need to see fundamentals improve, and I think we are starting to see that in office. The leasing environment has improved. We're starting to see more activity in places like New York and even San Francisco. So those two combinations need to come in together. But it definitely creates uncertainty in the markets today, and that's why REITs are trading where they are.
So you're saying can't get in until 2025?
Well, we'll start to look at 2025, so we might be into the REITs next year. But when you look over the next 12 months, rising interest rates, really uncertain economy, we're not really super bullish on REITs today.
Is there anywhere to hide in this sector, which has also traditionally been a safe spot, although the fact that it's a bond proxy and with all the real estate troubles doesn't feel so safe right now?
There are many companies. I think the really good thing about the REITs today versus the GFC is that the balance sheets are much better. So there are some blue chip companies with net debt to EBITDA in the 4 times range where they could be opportunistic on acquisitions if there are distressed sales.
And you like Prologis as one of those?
Prologis, Camden Property and Multifamily with like Avalon Bay. In office, we like BXP, formerly Boston Properties. All very good balance sheets. They're not going to have a lot of refinancing risk compared to some others.
When you get pushback, is it about current valuation or longer-term doubt about vacancies recovering to prior trend?
The pushback is really on deceleration. Like right now, demand for most asset classes are coming down. And on office, we are starting to see activity on leasing, but occupancy is not really picking up. So anecdotally, a lot of these things in office feel better, but we're not really seeing it in the numbers yet. But in other asset classes like multifamily, industrial, storage, there's other asset classes where demand is not as strong as it was earlier this year.
And what about dividend yields, John? You know, there was a time a lot of them were far ahead of the 10-year. That may not be the case any longer, although given the drop in the REITs overall, perhaps those dividends are keeping up.
Normally, you want to see the dividend yield above where the 10-year is at today, and right now it's at a negative spread. And for some companies with a lot of growth, you could stomach that. But right now, we'd like to see either rates come down or growth kind of lead to higher dividend growth.